And hell's coming with me, you hear? Hell's coming with me!
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to it, folks. We have some interesting stuff to talk about. This is really more of a chat today, because there's some things in place, things moving, and we've talked about debt profiles. Remember, for those of you who've been around a while, we haven't talked about debt profiles in a while, not since the last big downturn, but I think that's an important concept for us to keep in our minds as we move through the rest of this year. And I heard a conversation this weekend that was identical to conversations we were having about the downturn in 2006, but the word houses was switched for another word. So we're going to talk about that a little bit. Forbes had an article out, Housing Market Meltdown Intensifies, and this was July 18th. Home builders halt construction as confidence plunges to two-year low. And I don't think we need, I think we need to look at this in the context of what's going on. I think saying it's a two-year low is I guess some level of dazzle, but I honestly think that this rocks the confidence to the core of builders to the point that they've halted construction on homes. Now, to me, that doesn't translate to the next project isn't going to get started. That translates to we've stopped building developments we're working on right now. I'm trying to get absolute confirmation that that's what that means. But that's what happened last time. When we had the big downturn back 2006, 7, 8, new home builders, the ones that got caught right in the middle of it, the existing homes that had been built, it took us forever to get them sold. In fact, at the time that started, I was still, was I with them? No, I wasn't. I wasn't with the local office in Taro, but I was still working frequently with one of the agents who was involved in Taro's stuff. So I was getting sort of inside scoops on Intero now being the ones that were going to sell those properties. Now, of course, this was originally the builder had their own brokers doing their own thing with them. It got so bad, they'd sat there so long that Intero, some Intero agent that had a relationship with them was now the one that was out there trying to sell them. And they were on the market forever. Beautiful homes, but they were out there on the market forever. So why am I talking about this? At the same time, I'm recalling really all of the conversations we had in the downturn, starting in January when I started this show, January 2007, when we first started talking about the downturn, when we were trying to figure out how we were going to get out of it, what were the smart things for buyers, sellers, and investors to do at that time. A lot of the conversations we had, you could have templated to a conversation I had this weekend. But instead of the word homes, you could have stuck in the word cars. I knew, because I've shared it with you, that we've seen a dramatic increase in repossessions of cars. What I didn't realize was all of the same stupid things that they did with houses in the 2000s leading up to the downturn, monetizing subprime loans, right? Take that exact same word and apply it to cars, and that is what has happened. Not only have they gone whole hog on subprime lending, they've securitized them so that people could invest in car loans. And according to the folks I'm listening to, some of these folks are, and again, so I made jokes about a guy named Lucky Lopez on YouTube just because the name Lucky Lopez. I mean, how is that not the name of a car salesman? It is, right? But anyway, so he has this YouTube channel, and I covered the article in which he was mentioned. And I went back and listened to some of his stuff and a few others. And if you look at a normal, right? So, and this is, again, exact conversation we had when we were talking about houses back in the day. You know, the typical loan to value ratio in the car world was 90%, according to one individual, 80%. You know, houses are typically 80 to 90%, unless you're doing 3.5% or 4%. You know, there's different levels, but it was a conversation you could absolutely be having about houses, 12 years ago. But they were having them about cars, and the loan to value rate level they were seeing on some of these loans was 190%. I didn't stutter. 190%. And banks were just underwriting that stuff for whatever reason. And the thing that's crazy is anybody with a pulse could get a loan. Again, sound familiar? So all of the things that we learned, kind of learned in the downturn for houses, we took all of those bad ideas and apparently applied them to cars in the last couple of years. So now the big question in my mind is, the last time we had a huge downturn, it was a real estate focused downturn, right? It was a feeding frenzy and things bloated ridiculously because of easy money. And again, we could say the exact same thing for cars. And cars followed with the real estate focus. The origination of the fire was real estate last time. The origination of the fire this time is car financing. So, and to be more accurate about last time, it was real estate financing, right? They had done the same thing. If you had a pulse, you could get a loan. No doc loans, over 100% loan to value. Securitization of some prime loans. Super subprime lending, right? All of these things that fed this horrible beast that got us into a terrible thing. All right. So now, at what point can we say with confidence, the thing where it started doesn't matter? Because the whole house is going to burn down. It's interesting to know after the fact where the fire started, but do we care if it started in the garage with the car or with the house itself? Once it's all over, right? Once we're in it, once we are in the consequences of it, does it really matter where it started? So the question I find myself asking myself this weekend is, do we create simply the same thing as last time through subprime car lending? Because while we did all the same stupid things relating to lending on cars, the response to this lending has been far more nuts. And remember, the house lending was nuts at the time. We've got folks who bought cars, got these insane loans with bloated prices because, remember, because of these supply chain issues and other types of things, cars are selling way over MSRP for new cars, and used cars are selling for ridiculous prices, and they're getting financed. And what is scary is a whole bunch of these guys that are getting repossessed never made a payment. They bought the car, and they never made the first payment. So, who knows how much these folks have into the car? Is 0% financing a thing? Or not 0%. Is zero down financing a thing for cars? I know that if you have excellent credit, you can get zero down. I mean, when occasionally I'll dip myself into the world of cars to see how much it would cost to replace the car I'm in now. And I noticed that some of the loans I'm offered are no down loans. How common is that? I'm guessing it's fairly common since I hadn't filled out anything yet, and this were simply ads placed on websites where I was looking at cars. Now that's super scary to think someone has driven off with the asset, paid nothing, and then proceeded to never pay anything. No car payment, no nothing. And now their cars are getting repossessed. But here's where there's a difference, right? But I'm thinking it may be a distinction without a difference. Repossessing a car is very different from foreclosing on a house. Much more complicated process to foreclose on a house. You would think it would be easier since a house can't be driven around town, right? But apparently the way the rules work about repossessing a car, someone can simply go and take it and it's done, right? There's not a lot of legal stuff involved. So whatever the quote unquote damage is to the borrower happens right away. It's gonna go, right? It's not, you're not gonna sit in your car you're not paying for 2 years while the process of repossession is debated in courts, right? In a house, there's a year to 2 years. Heck, in some cases we had 3-4 years where people stayed in a house without ever paying the mortgage. So that, to me, spells an actually slower progression of the impact of the foreclosure, right? And the potential economic effect. With a car, within a couple of months, your car is going to be gone. And you are going to have debt that you owe. They can repossess the car, but you still owe a certain amount of money, right? They take back the asset, but if I'm not mistaken, there is still an amount of money you owe when your car gets repossessed. So there's that. And clearly these are folks who don't have the money or they would have paid it. But if you have folks in that financial situation right now, and the impact of suddenly not having a car, I'm not able to get to work now because my car is gone, that kind of thing. What does that equal a now debt profile where we can disregard what got us there? In other words, we are now in the fourth box in a life is terrible economic situation game. Does it matter what boxes preceded it? Is my question. Does that make sense? If I'm sounding very confused, I apologize. But what I want to find out is, at some point, are we simply destined to see the same thing economically as we saw last time, right? Because the real estate thing, one of the things that happened when real estate was the origination point of a bad economic scenario was suddenly real estate crashed, obviously. But as a result of that, all of a sudden cars were being repossessed. Granted, a huge number of those cars used to belong to real estate agents, but there was a huge car crash as well. And then crashes and other things, right? Stock markets, everything else. Because one of the things that enlarged that mushroom cloud of damage was the securitization of those loans, the house loans, right? The mortgages. And that apparently has been done again now with the car thing. Now, other little tidbits to consider. Far more car loan repossessions are happening, right? Then, in other words, my understanding is that they're up 52% this year. Well, we didn't see a 52% jump. 52% of homes weren't being repossessed, right? Or homes with mortgages were being repossessed. So the broadness of it is wider. According to an article from Barron's, origination dates are normally scattered because people fall on hard times at different times. Loan-to-value ratios, or the amount financed relative to the value of the vehicle, are around 140% versus the normal 80%. So on this particular article, they're talking 140. Lucky Lopez was saying up to 190 in some cases. And the loans were extended to buyers who had temporary pops in income during the pandemic. Those monthly incomes fell sometimes by half. So that's one element of it. Another element is the payments themselves are in some cases at mortgage levels. Car loan payments are the most ever, sometimes at mortgage levels. This was an article from NASDAQ from July 10th. Call it a case of double whammy. A shortage of new vehicles caused by pandemic-era supply chain backlogs drove up car prices. In May, the average transaction price of a new vehicle was up 13% year over year to $47,148, according to Kelley Blue Book. In addition to that, interest payments are higher because the Federal Reserve is engaged in a rate-raising duel against inflation. The average annual rate on a new car loan last month was 5.2%, up from 4.4%. A record 12.7% of people who took out a loan on a new car last month agreed to a monthly payment of at least $1,000, according to Edmunds. That is $300 more than the mortgage on the first home I bought. That is nearly double the 7% from a year ago, and more than 6 times the 2% in 2010. And then this article mentions Lucky Lopez, a car dealer who specializes in repossessed vehicles, told Barron's that the share of subprime auto loans that end up as repossessions has almost doubled since 2020 to 11%. Overall, 5.36 of the subprime auto loans were severely delinquent in May, 130 basis points higher than a year ago. What I would love to see here is the total. I wanted to say 1 point something trillion dollars, but I can't swear to that. So I'm not going to say it. I want to say it was 1 point something. Could it have been billion? I honestly, I'm not sure that it matters. I'm going to go ahead and include a link to the Lucky Lopez YouTube channel and to also another one called The Homework Guy, who's also just kind of out there giving people information about car stuff. That I think sort of sets the stage, right? There's always some sort of a thing, whether it's the financing that was insane for homes last time or insane financing for cars. Just before starting recording this show, I was listening to another video that was literally posted on Sunday by Lucky Lopez about how they're turning off the spigot for all the lending and things are going to grind to a halt and interest rates are going to go up and all these kinds of things. And apparently the timing, according to his experience, was a little aggressive for that. Normally that doesn't happen until either later in the year or at the end after taxes, that type of thing. But everyone's panicking now about the car thing. And as some other side notes of realities in our marketplaces, all sorts of, you can go on to Barron's, you can go to Forbes, you can go any of these websites, and you'll see headlines that companies are downsizing. They overhired over the last 2 years. I know for a fact that there are companies here in my market, that Silicon Valley, that are looking to downsize. There is a lot of churn out in the marketplace that bad things are coming and people need to tighten their belts. And one of the places where that happens is with hiring freezes and eliminating certain organizations within the corporation. I'm waiting to see how that goes. I've heard about it happening. I haven't seen huge numbers about it actually happening, but these are things that are apparently in the works. So it helps us arrive really at a conclusion that I've been pushing for a while. We are in a recession. And I realize I get folks in the comments who go, well, we're not officially in a recession. Well, we have now had 2 quarters of dropping GDP. We are also now seeing this thing with the auto loans, I think, is going to be an absolute, at least, even if you downplay it as much as possible, put people in a mindset. And unfortunately, like so many other things, once people start believing it's bad times come because they do things and take precautions that tend to also bring on the bad thing, right? If you believe bad times are coming and you're a CEO, maybe you start talking about doing layoffs. Right. Well, one of the things that pushes us into a recession is a reduction in workforce, a reduction in productivity. Right. These are things that then make it worse. So, and we can have arguments about all that up and down all day long, but really it's the outcome that I think we need to focus on. And I think the outcome pushes us into rougher economic territory on par with what we saw after the last downturn in 2006, 7, and 8, which should be pretty scary for an awful lot of folks. I don't know how long it'll last. There's no way really to tell, but all of the various oars are in the water that pushed us towards the downturn last time. This time, though, it's just simply a different tipping point where car loans seem to be a focus, whereas last time it was home loans. So I'm interesting to see where this is going to go. What's that curse? May you live in interesting times. One thing that you can take out of this is once this hits the fan, right? Because here's the next thing that happens. With all of these repossessions, cars come back to banks, right? But these cars that were financed at 122%, 100 or 140%, 180%, whatever, they're never going to get that money back. And this is what hit us last time. If you ultimately come down to banks simply weren't getting the money for the assets they had financed, right? They loaned money on a thing, and then bad things happened, and people who owed them money stopped paying them. In conjunction with securitization of those loans, where other businesses that invested in them, like whatever, different types of investments, whether for retirement funds or whatever else. Same thing happened with houses. This time, it's happening much more across the board. I believe right now the repossession rate is at about 10%. I believe it's actually at 8-point-something% according to what Lucky Lopez was talking about today, but believes it'll go to 10%, and in 2008 it was at 14%. And we're at the beginning of this. I don't think we've reached the peak of this car thing. So is 14% in the cards? I think it is super reasonable to assume that we'll get at least there. But let's also talk about the potential impact. Back in 88, the loan to value was about what we talked about, 88%, 90%. Today, there is no hope because these banks are going to try to sell these cars at auction. And the best case scenario, if they're super clean, they're going to get 75% of the value of the vehicle. Where they financed it at, say, 140%. And the person who bought it put down $4,000, $5,000 maybe. So these banks are all going to lose a ton of money. Now, what happens when banks lose tons of money? Well, the last time that happened, government stepped out and bailed them out, right? Remember TARP? Something I profoundly disagreed with. If banks did this kind of dumb stuff, they need to either survive it, however they decide to survive it, or they need to go out of business and get bought up by another bank. Or smaller banks that were smart about how they loaned it can buy up all the assets of these going out of business banks. That is the natural selection of the business world that's supposed to exist, that often is derailed by government intervention. So, what does this mean? Well, if you're shopping for a car, it means that in a few months, you're probably going to be able to get a really good deal on a car. There will be tons of inventory. There will be, since lending will be so cut off, the spigot is closed. And according to Lucky Lopez, that closing of the spigot happens today, Monday. July 25th is the closing of the spigot on lending for cars. No more over 100%, no more, zero money down, all that kind of stuff. It's going to be super strict. So suddenly the pool of buyers that are available for the cars that are out there is going to shrink dramatically. And the number of cars out there that need to get sold is going to jump dramatically. And think back to what we've always talked about relating to supply and demand. There's going to be a huge supply and a very low demand. So I am holding off. If I was ever thinking about buying a car, I've been thinking about buying an RV recently. And with the huge surge in RV purchases over the last 2 years, and the reality of what's going on now, I can't help but think that this is going to not only affect cars, but also affect RVs. So we'll see. Who knows? Maybe the next 12 months will be the time I'm able to get a great deal on a car and maybe even a better deal on an RV, but we'll see. But in terms of real estate, this all impacts the debt profile, right? That thing we talk about. And once the debt profile gets to a certain point, which seems to be getting fed by this, homes naturally follow. In fact, they may follow faster than cars followed last time. And cars followed pretty quickly. So I think there's a lot of potential. I think that if you are someone, and I am not normal. I am a guy who enjoys spending a quality hour or two each day just checking out all the homes that came on the market in the various markets that I serve, taking a look at how many homes had their price reduced or price increased, or homes that expired where their home didn't get sold over the period of time it was listed. So I'm always sort of consuming that. So I'm always plugged in to what the pulse of the market, I guess you could say, what's happening right now. And I would suggest that you don't need to do that, but you should get yourself on a list of if you're looking for an investment property, and particularly if you're looking for an investment property, or you want a house hack, you want to get a duplex, I would suggest you start asking your favorite realtor, and I hope if you live in the Bay Area, that's me. If not, please put me on your list of agents to consider when the time comes. All I want is a chance to have a chat with you to decide who the best person to work with you is. Get yourself a list. You can subscribe to a quick market rundown for your neighborhood. I have one that I can send to you. You can get a home search that is sent to you daily, weekly, monthly, whatever you prefer. Again, something I can set up for you. That'll just give you what's going on. It'll show you what's listed, what's sold, those types of things. Give you a feel for the market, because if things, you may be stunned. In 6 months, you may think, holy mackerel, I can't believe that this neighborhood where the average price was $1.5 million is now $900,000. Or maybe it's not a super local area. Maybe it's not an area that you live in or you want to live in, but maybe it's an area you want to invest in, and prices have been just out of range for you at, say, $800,000, $900,000. Wow, things have dropped to $500,000. It's just in having the information, right? The information doesn't need to cost you anything, and knowledge is power. So I'm going to strongly suggest you do that. Feel free to reach out to me at soldbyrobert.com if you would like to set something up. And I have a bunch of different tools. I can right now, I think I have a tool that's very good for your specific house in terms of giving you an estimate of value. I have a great one that gives you a rundown of what's been going on for the last 30 days in different areas. We can define the area that you look at literally by drawing on a map. Or we can just have a regular search. I think the search is probably the best one to go with, just because there's a higher level of granularity, but not required. You can simply be looking at what's on the market. But if you really want to drill down and look at a specific property, you have that option. Not so much with some of these other tools. But anyway, that would be my suggestion. And if you're an active investor, get ready. I think that you're going to find amazing opportunities. If you are someone who was thinking you need to sell your house relatively soon, do it fast. At least get an assessment of what's going on with your area right now. There are still some areas where sales are very strong. In my particular area, if I wanted to sell my home, I think I could put it on the market, do very little to it, and sell it relatively quickly for what I believe would be pretty much top dollar. But I think if I wait 6 months, that's not going to be true. I think there's a very high probability that in 6 months, either the price will have gone down a little bit or it'll be the same. So, all right. I hope that's been helpful, folks. I normally like to leave you with at least something positive. I guess the positive thing is if your money situation is good, your credit rating is good, and listen to the Lucky Lopez video that he just did on the 24th. I wasn't aware of some of the realities of the car sales business, and apparently a 650 credit rating is pretty common in that business. So they clearly have a much more subprime lending seems like a much more mainstream thing in the car selling business than it has historically been in houses. Although, like I said, we've lived through scenarios where if you had a pulse, you could get a loan on a house. So we've been there. But a car is a so much more risky thing to finance simply because it can move and run away from you. I'm a little stunned that it's that freewheeling. But anyway. All right, folks, I hope that's been useful information for you. I know it's at least the kind of stuff that makes you want to get an adult beverage and sort of sit quietly for a while and wonder where things are going to go. I would also like to congratulate clients of mine who just had their first baby boy. I'm not going to give you their names because I didn't ask them if it would be okay if I used their names. We'll just say R and K. Congrats on the new baby. I couldn't be happier for you guys. And I realize the part I played in that was absolutely minuscule, but I love that we got you into a house where you could start building your family, and that's happening. So I want everyone to put good vibes out to R and K. Great clients of mine. I love these folks, and I love that their life is moving forward for them in such a wonderful fashion. They sent me the photo of the little human meatloaf, and he's ridiculously cute. So anyway, just thought I'd share that. And also, I don't know if I mentioned this in this podcast yet? This podcast was ranked in the top 10 real estate podcasts for 2022 by Berksy. That's Berksy.com, BERXI.com, I believe. And you can also, if you want to see the article where they gave those top 10 real estate podcasts, you can head over to therebelbroker.com, and there's a little banner right below the player for all the episodes. They'll give you a link right to that article. So thanks to them for ranking the show so high, and I'm honored to be included on such a list. So anyway, all right. Thanks again for listening, everybody. Hope you have a good week, and I look forward to speaking to all of you next time.